This lecture is about break-even analysis. You may have heard of it or have seen it or learned it in another marketing course. However, in this lecture, we'll go in depth and I'll provide you with an in-depth analysis of how it works and the applications. So we have 6 learning objectives in this lecture and in this PowerPoint presentation. First, we'll describe what break-even analysis is. Second, we'll talk about the applications of break-even analysis, especially in marketing. Third, we'll talk about the assumptions that we typically make but not always spelled out explicitly before a break-even analysis is done. Number 4, we need to identify and define key variables in the break-even equation, basically the equation to calculate break-even points. Next, we need to enter some data in a spreadsheet and calculate break-even units and dollar revenue and graph from that spreadsheet figure. The final objective is to graph the costs and revenues to identify break-even points. So let's get started. So the definition. The break-even analysis is a short-term decision-making tool that identifies relationships between changes in sales volume, total revenue, and profit, given some cost structure, of course. Break-even analysis is widely used in finance, accounting, and economics, and I think the marketing discipline borrowed this from those disciplines. In any case, we use break-even analysis to analyze profitability of new enterprises like a startup company or new projects, or to determine pricing at which will be profitable and how many units will it take before we can recoup a major part of our costs. Break-even analysis is also known as CVP analysis. CVP is for cost, volume, and profit. And I believe this CVP belongs to the accounting discipline. In any case, let's talk about the applications. Break-even analysis is an important managerial tool to aid short-term planning and decision-making. Remember, the focus is on short-term because in the long term, many of the assumptions that we make are no longer valid, and therefore this analysis kind of loses its applicability for long-term planning. Second, it enables managers to examine relationships between cost, revenue, output levels, and profit. So you can optimize or determine which output level you are happy with. Last but not the least, break-even analysis can be applied to short-term decisions such as choices of sales mix and pricing policy. So here are some specific examples of applications. Questions like how many units must be sold to break even financially? How many units must be sold to achieve a targeted level of profit? Or should a special order be accepted? If a customer places a special order, you need to factor into the fixed cost and the price and figure out if you're going to make any money. Another example is how will profits be affected if we introduce a new product or service? So let's go over the assumptions that are implicitly or explicitly made. It's good to go over those. First assumption is that all costs can be clearly divided into fixed cost and variable cost types. Those are the two kinds of costs that we'll be dealing with. And oftentimes certain costs are not clearly identifiable as fixed or variable. So if that's the case, that limits the applicability. But if you have a clear definition of fixed and variable costs, then this analysis works without problems. Next assumption is production is the only reason for incurring costs. There may be other reasons, other sources of costs in a business, but we are assuming that the costs happen because you're producing additional units of output. You're making more products, and therefore there will be costs associated with it. The third assumption is one uniform product is being considered in a break-even analysis. You can certainly consider a product mix or product line, but the sales or production in those product lines need to move in fixed proportions. So that's another assumption that we need to make, or it needs to hold. The fourth assumption is whatever is produced will be sold. In other words, there are no provisions for surplus or inventory, and this model doesn't allow that. And the last assumption is the unit price, meaning the selling price is assumed fixed. You can alter the selling price, but a new break-even point will result if the price is changed. So here are the key definitions. Total costs, as we mentioned before, is comprised of fixed cost and variable cost. So basically it's the sum of fixed cost plus variable cost. Variable cost is any cost that's incurred when production is going on, meaning when one additional unit is produced or sold, what is the incremental cost? And of all the units produced, there will be some additional cost. So that's the variable cost. Variable costs typically include energy, fuel bills, cost of raw materials, delivery costs, anything that's proportional to the production. Average variable cost is basically variable cost divided by the number of units or the quantity of goods produced. Fixed costs are any cost that's incurred even before production can take place, or regardless of production level, these costs must be paid. Examples of fixed costs are long-term lease, equipment or capital expense that once made may not be recouped. Next definition is contribution margin. Contribution margin is basically unit price or selling price minus the unit variable cost. If you sell at a price that's above the average variable cost, then you have a little surplus that goes toward paying fixed cost. And once fixed cost is paid or recouped, additional surplus turns into profit. Margin of safety. This is another concept we are going to learn in addition to break-even analysis. So margin of safety is a measure in which the budgeted volume of sales is compared with the volume of sales that's required to break even. And we'll have examples to illustrate margin of safety. So the break-even equation is basically, there are two ways of calculating break-even points. So as you saw the definition, the break-even points refers to unit volume or sales revenue at which the total cost is recouped and no profit has been made yet. So in terms of volume units, break-even units equals fixed costs divided by the contribution margin. And the contribution margin is basically unit price minus unit variable cost or average variable cost. You can also calculate break-even point in terms of dollar figure, like dollar revenue. How much revenue do you have to make in order to break even? And to calculate that, we divide fixed cost by the contribution margin ratio instead of the flat contribution margin. And the contribution margin ratio is calculated as contribution margin per unit, just like we did before, and divided by the per unit selling price. So if a company's current sales are more than its break-even point, it has a margin of safety equal to current sales minus the break-even sales. The margin of safety is the amount by which sales can decrease before the company incurs a loss. So this is sort of like a safety measure. So let's talk about an example. So the following data in a smaller fonts would be given to you. These are the assumptions or inputs, if you will. And we'll have problems on the test, final exam, similar to these. So let's assume that you were told the selling price is $50 a piece. Variable cost is $40 a piece. So this should be average variable cost. And total fixed cost is $70,000, and the budgeted sales equals 7,500 units. So the first task is to find the break-even point in terms of volume units, which is total fixed cost divided by the contribution margin. So the contribution margin is selling price, which is $50, minus the average variable cost, which is $40. So the $10 is the contribution margin, and that's explained here in brown font. So 70,000 divided by 10 is 7,000 units. So that is the break-even point in terms of units. Now, in terms of dollar figure, you divide the same $70,000, but divide by the contribution margin ratio. So the contribution margin ratio in this case is 20%, which is basically 10 and the contribution margin itself divided by the selling price. So 10 divided by 50 is 20%. So you have to make a revenue of $350,000 before you break even. And the margin of safety is basically the difference between break-even units and your budgeted sales. So the budgeted sales is 7,500 units, and your break-even units is 7,000, resulting 500 units is your margin of safety. So in case your sale falls below your budgeted sales by 500 units, up to 500 units, you're okay, you can break even. But if it falls more than 500 units, you're going to incur a loss. So here's another example to illustrate the break-even point, and I left this as a problem for you as a exercise. So let's say this is a video production company. They produce videotapes and they sell those at $20 each. The fixed cost for production is $40,000, and the variable cost is $12 per unit. So pretty straightforward. You will divide the fixed cost by the contribution margin. And the contribution margin is already calculated for you. It's $20 selling price minus $12 variable cost. So that's $8. So what is the break-even point in units? While you are at it, you can also calculate the break-even points in terms of revenue. So that's left as an exercise. Shouldn't be too difficult. If it is, email me or let me know, and we can take it from there. So this spreadsheet is created based on the first example that was discussed and solved, not left as an exercise, in other words. So again, the given information or the inputs are per unit price, average variable cost, and fixed cost. And I created the units in $500 increments, and then these are actually formulas. Total revenue is basically price times units, and I will post the spreadsheet in Blackboard next to this PowerPoint, so you will see all the formulas in there. If you move your cursor, you will see all the formulas. As you can see, 7,000 units produces zero profit, and that's the break-even unit. And you can also see that revenue, total revenue is 350,000. So that's the revenue figure for break-even point, and it all makes sense. And the same amount would be total cost because the profit is zero. And I created this chart or graph based on the data you just saw in the prior slide. And below the break-even units of sales, you have loss, and the difference between these, if you shaded this area, that would represent the loss. And you make profit at any units sold higher than 7,000 units. So this area, the difference between blue and orange line is the profit. And you can create the same graph based on the data that I will post in a spreadsheet. I think the graph is also there in the spreadsheet. So here's another example left as a homework. This is a little bit more difficult because the fixed costs are not straight given to you. Instead, the fixed and variable costs are mixed up here. So your task is to divide this cost into fixed and variable components. But the unit price is given, the ticket price in this case. So this is like a Max's dinner theater. So they need to sell certain number of tickets in order to break even. So you have the price, and you can calculate the fixed cost. You can calculate the average variable cost. So that's the lecture. I hope you understood the break-even analysis. If not, let me know.